And very warm welcome to Mushonomics. This is our 12th class, and we will be discussing here calculation of GDP. There are calculation methods, so income method, expenditure method, or product method, which is also known as gross value addition method. So we will be discussing these things here today. This is our WhatsApp channel, Twitter handle, Insta handle, Telegram channel with the name Mushonomics. This you can join to get regular updates on current affairs, These things you will get here, right? And this is the number where you can drop your messages and you can give your suggestions and you can talk about it, right? Fine. So so in the last class we discussed about the circular flow model. I hope you remember it. If you have not seen it and if you don't have any idea about it, you can go back and check the previous video. We talked about circular flow model, right? So this entire calculation will be depend on that particular model only, because by circular flow we understood that the value of income total value of income is equal to total value of production total value of production, which is equal to total value of expenditure in the economy. So in an economy, these things remains the same. Total value of income is equal to total value of production is equal to total value of expenditure. And from here we get this by income method, calculation of GDP by income method, calculation of GDP by product method, also known as value added or value addition method, and this is known as expenditure method, right? So these are the three methods that we have to discuss, that how to calculate GDP, expenditure method. So let's start with the first method, that is income method. Income method for the calculation of GDP. Let's see how it is being calculated. So what we will calculate here, we will calculate total income in the economy. So what we will calculate, total income in an economy. So total income in an economy, how we can represent total income in an economy. So total income in an economy can be represented as for example, we can talk about rent, right, for the land, and we can also talk about royalty, right, the things where for intellectual properties, etc., we get royalty. So rent plus royalty is an income of an household. What other things can be the source of income of household? So like we studied for the factor of production, primary factor of production, land, labor, etc. So there we talked about land, then we talk about labor. So for land we get rent, for intellectual property right things we get royalty, and for the labor we get wages and salary. But if you remember, we talk about except wages and salary, the term is known as operating surplus. So we are talking about operating surplus right now. So for capital we get interest, right, interest as an income if we are investing some capital. And for running the business, the entrepreneur or enterprise will get what, profit. This is known as operating surplus. These things are known as what, operating surplus. I will call it as number 1, group 1. Okay, and then we have wages and salary, salaries, right, wages and salaries. This is known as compensation to employees, compensation of employees, right? And the third thing that we can have here is known as what, mixed income. mixed income of self-employed. Mixed income of self-employed. Let's give it number 3. So here compensation of employees will be number 2 and mixed income of self-employed people will be number 3. Now for whom we will be using this mixed income for self-employed, for what type of people we will be using it? So it is used when there is no separate data. It is used when we don't have separate data on rent, wages, interest and profit. So when we don't have separate data on these things, the rent, wages, interest and profit, then we take it as mixed income of self-employed, right? So these are the 3 good groups that we can talk about under income method. So when we combine all these 3, 1, 2 and 3, what we get basically, we will be getting here net domestic product. What we will be getting here, net domestic product at factor cost. Now how these things will come up? So see, since we are talking about income method, right? We are talking about income method. So in under income method, we are not taking depreciation under consideration, right? So this is net. And why we are talking about factor cost? Because it is factor income and it has nothing to do with the market prices, right? So the variant of GDP what we get through income method is net domestic product at factor cost. Now if we want to get GDP at market price, what changes we can do? For example, if we will take depreciation into consideration, what we will be getting here, NDP at factor cost. And if we want to get market price here, sorry, not NDP, GDP. If we add depreciation here, what we will be getting here is GDP at factor cost, right? Gross. Now if we take net indirect taxes into the consideration, then it will become what? GDP at market price. So let's see once again. So we are calculating GDP by income method. So we are taking income of all the sectors present in the economy, right? So for households, we talk about rent, royalty or interest, profit. These things we get in the exchange of factor of production, right? So wages and salary for the employee. And then if we don't have separate data for on rent, wages, interest, etc., then we take what? Self-employed people, mixed income of self-employed people. Now if we add all these 3, there is no tax data included here, there is no depreciation included here, right? So we get very simple variant of GDP, that is net domestic product at factor cost. Very simple variation of national income, net domestic product at factor cost. Now if you want to get a GDP at market price, so to convert net into gross, we have what? To convert net into gross, we have depreciation. So if we include depreciation, we get GDP at factor cost. Now to convert it into market price, if we want to convert it into market price, then we will be adding net indirect tax in it. Now this NDP at factor cost, this is also known as, this NDP at factor cost is also known as or also referred as domestic factor income, also referred as domestic factor income, right? Okay, now this is the one method, income method, by which we can calculate GDP. Let's move to our second method, that is expenditure method. So second method is expenditure method. Here we will be doing what? We will be taking into the consideration of expenditure done by all the sectors in the society. So we will be talking about expenditure method. So what do we mean by expenditure method then? Total expenditure made by all sectors total expenditure made by all sectors on final goods and services. We will be taking final goods and services, right? Produced services produced in domestic territory of an economy, right? So if we talk about total expenditure, in an economy, how we can calculate this total expenditure? Total expenditure by households we can take, total expenditure by firms we can take, total expenditure by government we can take, right? And total expenditure from external sector. These things we can take. Now for example, if we want to take total expenditure done by household, so this is known as what? This is also known as private final consumption expenditure. Private, right? Because what is done by the government is known as public expenditure. So private final consumption expenditure, right? In economics we denote this term as C, capital C, consumption expenditure, right? Now by firms, the expenditure that we do is known as what? Gross domestic capital formation. The expenditure done by the firms is known as what? Capital formation. So it can be gross, it can be net also, but since depreciation is included, so we talk about gross domestic capital formation. Because firms will be investing, right? The expenditure of firm will be investment. So this is represented as I. Why this is represented as I? Because capital formation, this capital formation is also known as what? Investment. So that's why gross domestic capital formation or gross investment. So it will be represented by letter I. By the government it is known as government's expenditure, right? So it is represented by letter G, government's expenditure. And by external sector, when we talk about, so we talk about net exports here. The expenditure done by external sector is known as what? Net exports. Net exports means what? Exports minus imports. Now this is represented as X minus M, or you can represent it as net exports like NX. Okay, so this is the total expenditure done in an economy. So if we take all these things, this consumption expenditure, private final consumption expenditure, that is C, plus this capital formation and investment, that is C plus I, and the government expenditure, that is G, and the net exports, that is NX, what we will be getting here? So we will be getting here GDP at market price. This is the result that we will be having. How GDP at market price? Because all the expenditure that we are doing is at market price. Why gross? Because we are taking gross domestic capital formation here. So the value of depreciation is included in it, right? So it will give us what? GDP at market price. So by expenditure method we get this variant of GDP. Mind you, in during the calculation of GDP, under income method we got GDP, we got NDP at factor cost, then we added value of depreciation, then we added value of net indirect tax, and finally we got GDP at market price. But under expenditure method we directly get GDP at market price, right? Now one more method is there, that is very simple, that we have to study for GDP calculation, that is known as what? Product method. Or value added method. Now let's see how these things are being calculated. So value added example we have already seen for value addition, right? Now let's simplify it. So it is nothing but total value addition done by all the firms, done by all the firms, all the firms in a domestic territory, all the firms in a domestic territory, right? It is what it is known as product method or value addition method. So if we talk about, that is the gross value of output. How we calculate value addition? Gross value of output at market price, minus value of intermediate goods purchased. That is the value addition, right? I gave you the example of tea seller, that who purchased the milk worth rupees 20, sugar worth rupees 10, and do value addition and keep sell this particular cup of tea worth rupees 100. So 70 rupees is the value addition, right? So gross value of output at market price minus the value of intermediate goods, value of intermediate goods purchased, right? So it will give you what, this will give you value of gross value of, so if we take this value gross, it will give us this value gross. If we take this value net, this will give us net also, right? So gross value added at market price, gross value added at market price, right? And if we sum all the value addition done by all the firms in the economy, that is gross value added at market price, this is nothing but our GDP at market price. So we get GDP at market price by this particular method also, right? So these are the three method of calculation of GDP that we studied. Now one more term we have to study, and then we will be mostly finishing on this particular chapter. Maybe one more video is needed to discuss upon the recent developments, etc. But let's talk about one more factor here, that is gross national product. Gross national product. What do we mean by gross national product, or maybe we can call it as GNP, gross national product? Let's understand this. The value of final goods and services. Now there is a difference between GDP and GNP. When we talk about GDP, we take consideration into the domestic territory of a country, right? Domestic territory. But when we talk about GNP, we take into consideration the nationals of a country. Nationals. These nationals may be in India, may be outside India. But when we talk about GDP, we take domestic territory only. So we talk about the value of production happening only in India. But when we talk about GNP, India and outside India both, but by nationals only, by Indian nationals only, right? So the value of final goods and services, the value of final goods and services produced or earned by normal residents, of a country, right? What do we mean by normal residents? Normal residents are nothing but individuals who live in a country for more than 1 year, and whose center of economic interest is in that particular country only. country only, right? So this is known as normal residents. And the value of final goods and services produced or earned by normal resident of a country. These normal resident may be living inside India or outside India. And with the same in the same manner, for example, this is the domestic territory of India, and this is outside India. Suppose this is outside India. Now, when we calculate GDP, we talk about only value of goods and services produced in India. But when we talk about GNP, nationals, for example, if we talk about nationals, okay, we can take example of nationals only. Nationals of India, normal resident of India, we can take. So, residents of India, residents of India. And outside India also there are residents of India, right? Outside also there are residents of India. So when we calculate GNP, what we have to do first, if we are taking GDP, in GDP we have included the income of foreigners also, right? And in GDP we have not included income earned from abroad, right? Income earned from abroad. So what we will be doing here in GDP, if we add factor income earned from abroad, earned from abroad, earned from abroad, and if we subtract the factor income earned by foreign national, that is paid to abroad, so factor income paid to abroad, what will be getting here? We will be getting gross national product. We will be getting here gross national product. And gross national product here, if it is a market price, then here also it will be at market price only. So GNP that we have got now, gross national product at market price, right? I hope you understood. This is the concept that in India we have added incomes earned by Indians or the normal resident of India, and then from foreign also we have taken the income earned by nationals or residents of India, right? Then we have subtracted the income earned by foreigners in India, right? This is the simple thing that we have got. Now suppose, and this particular thing what we have done here, this factor income earned from abroad minus net factor income paid to abroad, this is known as NFIA. This is known as what? NFIA. What do we mean by NFIA? NFIA is nothing but net factor income from abroad, NFIA, right? So this is how we get GNP from GDP, right? So this is now what we can do here. Suppose we have net domestic product at factor cost, and if we add NFIA into this, what we will be getting here? NNP at factor cost, net national product at factor cost, because between domestic product and national product, what we are having, the variant is NFIA, right? And this is known as national income. NNP at factor cost is known as what? National income, right? What do we mean by this? NNP at factor cost, that is total income earned by all the normal residents of an economy, normal residents of an economy in a given accounting year, right? So this is what the net national product, right? Now one thing I want you to understand here, right? We have discussed so many variants like GDP, NDP, right? So we have discussed gross and net, right? So what is the difference between gross and net? The difference is of depreciation, right? The difference is of depreciation. Then we discussed something like market price and factor cost. So what will be the difference between market price and factor cost? That is related to net indirect tax. Net indirect tax. In last class we have seen all these things. Then we have discussed between domestic product and national product. So domestic product, domestic or national. So in domestic and national, what is the difference? In domestic and national, there is a difference of NFIA, net factor income from abroad, right? So these are the variants. Now on the basis of these things, and one more thing we have discussed, that is nominal and real. Nominal and real, right? In nominal and real, there is the concept behind these things is base year or constant prices and current prices, right? I hope you remember we have discussed these things in detail. Now these are the concepts: gross, net, market price, factor cost, market price, factor cost, right? Domestic, national, and nominal and real. Now on the basis of these things, we get so many variants of GDP or national income, we can say national income variants or GDP that we can say. Now let's see how many variants that we can plot here on the basis of these concepts. So we can get here 16 possible variants, 16 such variants we can get here. Now let's see how. For example, we are getting here real GDP, real GDP at market price. So in the same way, we can have nominal GDP at market price also, right? If we are taking if we are not fixing the prices, if we are taking prices of current year, then we will be having normal GDP at market prices, right? Similarly, we can have from market price, we can go to factor cost, right? From market price we can go to factor cost with the help of net indirect tax, right? So we will be having real GDP at factor cost, real GDP at factor cost. Same way we can have nominal GDP at factor cost, nominal GDP at factor cost. Okay, understood. Now from domestic to national, we have what? Net factor income from abroad. So net factor income from abroad, if we take, then it will become what? GNP, GNP at market price. So similarly we have real GNP at market price, then nominal GNP at market price, right? Then we will be having factor cost, right? So real GNP at factor cost, then real nominal, then we have nominal GNP at factor cost, right? Nominal GNP at factor cost. Okay, fine, we have understood this. Now with gross, if we subtract depreciation, we will be getting what? Net. So this will be real. Now from here we are getting to net, and this also we will be getting into net. So this will be what? Real NDP. Now not GDP, not gross, net. So net value. So NDP at market price. So here also it will become what? Nominal GNP at market price. Sorry, and not G, it is N. So nominal NDP at market price. Then we can have at factor cost, right? So real NDP at factor cost, then nominal NDP at factor cost, right? And we can also talk about real NNP at market price. Now again national product will come, right? If we subtract the NFIA, right? So this will be nominal NNP at market price. Now this is real NNP at factor cost. This is nominal NNP at factor cost, right? So I hope we understand the meaning of all these variants, that what things are included in it and what not. I hope we will be finishing on this national income part. One more class we will be needed of 20 or 25 minutes, and then we will be concluding it, and we will be moving towards the third module, that is balance of payment. So I hope you got some idea on the topics that we have discussed today. If you have any doubt related to all these things that we have discussed, you can drop your message on this WhatsApp number. You can call on this number as well, right? And these are the channels that you can follow, right? These are the Twitter handle, Insta handle that you can follow. Then take care and best wishes for your upcoming exams. We will be coming up with more classes with more topics. Thank you very much. Take care. Bye bye.